record. So the past few days we've been going we've been taking it from one level to another, and trying to begin to understand the markets, the financial markets, and how to actually do what we do in the markets, how to actually buy or sell in the markets. Because for you to be able to buy and sell or sell in the markets, there's an understanding that you need to have, right? Now, even when you take a signal for a buy or a sell, you will find that you do better when you have an understanding of the market and what you are doing, of the business that you're doing. Just like in every business, there is a need to have an understanding of how to make profit from what you are doing, right? Yes, eventually you may not have all the time, but the truth is that even when you don't have all the time, you still need a good understanding, a good in-depth understanding of what you are doing, of the business you just gotten started with, and how those are making money, how are they actually doing this thing, how are they actually making profit of this thing, right? So that's why we began to take it from one level to another to help us all understand this whole process. Okay, so we began talking about fundamental analysis, and then we had a bit of understanding about what's moving the market on the fundamental side, right? So when we're talking fundamental, we're talking news events that involves the world events and economic events. We had a discussion about all that and how that works, right? So now we began to get into the second part that we call technical analysis. So we got into that a few days ago and we've been making progress there. And the thing with technical analysis is that it has several parts to it. It has several parts to it. And when you understand the different parts to it, and you begin to practice them, it starts to make sense. And eventually we'll put everything together and then you see how this all makes sense together. So what we are doing now is we are taking the different parts of it now. That's what we are doing now. We're taking the different parts. And then eventually we'll start to put them all together and use it to do what we do in the markets, right? So yesterday we started talking about swings, right? We talked about support and resistance, floors and roofs, and then we started talking about swings, understanding swings. Because when you understand swings, you'll be able to use swings now to get support and resistance in the financial market. Because when you come on the chart, and like I've done in previous classes where I draw very smooth lines, very smooth price going up and down very smoothly, right? Something like this. When price goes up like this and it goes up like this, it goes up like that, it looks very smooth on the chart, right? But then in reality, in actual sense, in the market, it is usually not as smooth as this. And sometimes it's actually as smooth as this. Sometimes it's as smooth as this. Most of the time, it's not as smooth as this. But then you still need to be able to make sense of what's happening in the market, whether it's as smooth as this or not. It really doesn't matter, right? So, and that is when you begin to understand, when you understand all of these things in parts that we're talking about, you begin to make sense of the whole thing. This market is not complicated, but then you have to understand, when you understand the things you're meant to understand, then you see that it's not complicated. You see that it's not complicated, right? So initially we started talking about risk management, money management. That's something that a lot of us probably don't understand that very well. We'll come back to that. But for now, we'll stick with technical analysis. Today, we're going to be talking about the trend, right? Trend. So it's usually said that the trend is your friend. You will hear it very often. The trend is your friend. Now, why is the trend your friend? The trend is what I call the money flow in the market, okay? The trend is what I call the money flow in the market. It's just like, for example, there's a heavy rainfall or even a stream or a river. A river flows from one area to another, okay? If you know anything about rivers and water flows and all that, there's usually there's usually a point it's flowing from to a point to another point. It's flowing from one point to another. And usually because it's flowing from one point to another, if you were someone who wanted to, like those days where they have these boats that are not mechanized, and then you get on the boat, you want to be able to go in the direction that the water is going, because energy is flowing in that direction. Waves is energy, is flowing in that direction. So if you want to go against it, it will take you so much effort to go against, especially if the waves are very strong in a particular direction. So if the waves are very strong, let's say the waves are very strong in this direction, let's say this is what we are doing now, and water is flowing from this top to this bottom. Okay, water is flowing like this. So if water is flowing down like this, from this top left to this bottom right? Now, if water is flowing and the waves are so strong going down, it will be very difficult for you to start swimming like this. For you to swim like this, we're talking swimming now. For you to swim like this is going to be very difficult. And the truth is that if these waves are very heavy, it can be very, very dangerous to swim against it. It's only when the waves are light, water is flowing down, but the waves are light, then you can still swim. There, it will take a lot of effort to try to swim. But then, if these waves are very strong, it will be very dangerous. You stand a chance of getting washed away because you're trying to swim against the tide. Right? You're trying to swim against the tide. So you've even heard it, don't swim against the tide. So swimming with the tide is what the trend is all about. So if you trade in forex market, if you trade in the direction of the trend, you are swimming with the tide. If you trade against the trend, you are swimming against the tide. And it is very dangerous to swim against the tide. Here is the reason why it's dangerous to swim against the tide or go against the trend in this case. Now, in the financial market, every time you see candles moving, okay, every time you see candles, let's say you see candles moving like this, you see candles moving like this, it's moving downwards, right? Every time you see candles moving like this, understand something, price is moving downwards, right? The amount of money, the amount of financial movements that allow, the amount of investment and the amount of financial commitment by big time traders. And when I say big time traders, I mean institutional investors, I mean hedge funds, I mean these family funds, I mean funds that are billions and billions and billions and hundreds of billions of dollars. They are playing in the market. When you see price moving in, let's say from a top level point here to bottom, or is coming down, it takes a lot of money to make that happen. It takes a lot of push, a lot of pressure, financial pressure to make price come down. So as a retail trader, you don't have a lot of money. Even when you have $1 million, $1 million is small money in the forex market. Even when you have $1 million, $1 million is so small, you can't even start to think about how small it is. Compared to the monies that's moving in the market, $1 million is so tiny, too tiny. You see? So what you want to do then, as someone with $1,000, $500, $10,000, what you want to do is that you want to identify where is the flow. Like where is the trend going? Where is the current flowing to? Just like we talked about water. Where is it going to? Where is it flowing towards? When you know what it is flowing, where it is flowing towards, and you jump into the water, in that direction, you have no issues moving in that direction. So you find that water is flowing from this top here to this bottom, and you jump and swim in this direction. When you swim in the direction the water is already going, it's all very easy for you. But in this case, what you want to do with your retail money, which is 1,000, 10,000, whatever amount you have, is retail trading, is retail investing that you're doing. That's why it's called in retail. There's a difference between retail and institutional. Institutional is the ones I mentioned before. Huge funds, investment companies, hedge funds, and the rest of them. They are institutional investors. Okay, they pull funds together from billionaires. But you that has $10,000, $1,500 in your account, you are a retail trader. So as a retail trader, what you want to do is look into the market to see where the money is flowing to. So the trend, it tells you where the money is flowing towards. And what you need to do now is go in that direction. You don't go against it because you cannot survive. You cannot survive if you go against that trend, right? So that is the thing. So now there are different kinds of trends. Let's first of all explain this. In forex trading, a trend refers to the general direction in which the price of a currency pair is moving over a specific period of time. I'll take that again. In forex trading, a trend refers to the general direction in which the price of a currency pair is moving over a specific period of time. So that is very important because trends change all the time. So question is, I'm entering the market this morning. What is the trend of the instrument that I'm trading? If I'm trading Euro USD, or if I'm trading USD JPY, what is the trend of this instrument this morning? Or what is the recent trend, the most recent trend? Okay, it may not be trend for this money, but it may be the most recent trend. And that recent trend could be for over the past 1 week or 2 weeks or 3 weeks or 1 month. If that trend is still continuing, that's the trend I'm looking at. What is that trend? That's what I want to understand. Okay, so but understand there could be a trend that's been on for the past 1 week, and from today now, that change starts to change. That trend starts to change. We see that in the market all the time. So it's very important you understand that trends are usually for a specific period of time, and then they do change periodically from time to time. What we have to then do as traders is be able to be in a situation where we can identify those changes when they are happening or when they've happened. So if I was selling, if I came to Euro USD and the Euro USD trend was selling today or has been selling for the past 1 week, when tomorrow or when next week that trend changes from a sell to a buy, it is important that I'm able also to identify that, oh, this trend now has changed from a sell to a buy. It has been selling for the past 3 weeks, but now it has begun to buy. So it's important that I identify that. So that's what it is. So it's per time. It provides traders with valuable information about the market sentiment and can be useful for making trading decisions. Very, very important. Okay. So types of trends. So we have 3 types of trends. So we have an uptrend, we have a downtrend, and we have a sideways trend. So here it is. We have uptrend, number 1, uptrend. Number 2, downtrend. Number 3, sideways or range. Sideways trend or a range. So when you hear, oh, the market is ranging, that's what it's telling you, that the trend is sideways. So whatever you see in the market is a trend. But the question is it an uptrend? Is it a downtrend? Or is it a sideways trend? That's the question. Whatever you see in the market at every time is a trend. But the question is it an uptrend? Is it a downtrend? Or is it a sideways trend? So now, here's what happened. Let's look at the definitions here so that we can understand it before we start to take time to explain it further. So first of all, we have an uptrend. An uptrend occurs when the price of a currency pair is constantly making higher highs and higher lows. Take note of those words: higher highs and higher lows. There are things I'm going to illustrate for you now to help you understand what higher highs and higher lows are. Okay, so an uptrend occurs when the price of a currency pair is consistently making higher highs and higher lows. This indicates that the buyers are in control. This indicates that the buyers are in control and the market sentiment is bullish. Always remember, bullish means buy. Bullish means buy. Bullish means buy. 1 minute, guys. Okay, so bullish means buy. Anytime, anywhere you see bullish, we are talking about buying. Anywhere you see bearish, we are talking about sell. So think of it as bull and bear, bull and bear, bull and bear. Okay, you can even do it in such a way as to get pictures of that, just to give you just to help you make that association, and just to so that it can stick. Okay, so it indicates that the buyers are in control and the market sentiment is bullish, which means buying. Traders often look for opportunities to buy or go long in an uptrend. Now watch this. We are talking about three terms here now. We talk about bullish, we talk about buy, and we talk about long. Bullish, buy, long. Bullish, buy, long. So let me put this together. So buy, bullish, long. So that refers to buying, buying. So these are terms that are used for buying, to buy. So it's either you are buying or you heard the word bullish. Bullish still means buy. Long means buy. Bullish means buy means buy, long means buy. Okay. Another thing is sell, bearish, short. Okay. So when we say sell, we are talking about selling. When we say bearish, we are talking about sell also. When we say short, we are talking about sell too. So take note of this. Buy means buy, bullish means buy, long means buy. You can use any one of those. It's still the same. It's still the same language, right? It's the same language right there. So sell means sell, bearish means sell, short means sell. So let's continue what we're saying. So for an uptrend, you are looking, it indicates that the buyers are in control, and then you look for buy opportunities in an uptrend. Buy opportunities in an uptrend. Number two, downtrend. This downtrend now. A downtrend happens when the price of a currency pair is consistently making higher highs, lower highs, and lower lows. Okay, so first of all, in an uptrend, we talked about higher highs and higher lows. Now in a downtrend, we're talking about lower lows and lower highs and lower lows. So a downtrend happens when the price of a currency pair is consistently making lower highs and lower lows. So I will explain that in a bit, so we get it. This indicates that sellers are in control. This indicates that sellers are in control. And when sellers are in control and the market sentiment is bearish, bearish means sell. So market sentiment is bearish. Traders often seek opportunities to sell or go short in a downtrend. So you see that? Then the next one here is the sideways trend. The sideways trend. So sideways trend or a range is a sideways or range-bound market. We'll explain that as well so that you understand what a range-bound market is. Okay, so a sideways or a range-bound market, the price of a currency pair moves in a specific range without making higher highs and higher lows. Okay, we'll get there soon. The market sentiment is generally indecisive, and traders may look to trade opportunities within the range, such as buy near support and sell near resistance. So let's explain this. Let's explain this right now. So in an uptrend, what are we doing? We said we are consistently seeing higher highs and higher lows. So let me show you guys what a higher high and higher low is. Okay, so now whenever you come to the market, you are always going, remember, these illustrations are always more perfect than you may see in the market. These illustrations are always more perfect than you may see in the market, but sometimes you will see exactly what you illustrated. It's like textbook. You will see it like textbook in the market, right? But sometimes it is not like textbook. Sometimes it's not like textbook. It can look confusing in the market a bit. But the point is that it doesn't even matter. What you need to then do is to basically understand the concept. When you understand the concept, you always be able to use it in the market. Always. You always be able to use it. Okay. So now what you have to understand is every time you are on a chart, Let's look at this now. Let's assume that this right here is a chart. This right here right now is a chart, right? This now is a chart. Okay. So that's a chart. Now, the tops right here, these tops are called highs. The tops are called highs. Remember, we said higher highs, high. While these bottoms are called lows. Every time you are on a chart, always think about it. The outer part of the chart is called high. It's called the highs. The outer part of the chart is always called the highs, while the lower part is always called the lows. The outer part, the higher parts are the highs, the lower parts are the lows. So right now, what you notice is that there's a high here. High, H. H is a high, right? So now, when you are in an uptrend, you will notice that there's a formation of continued higher highs. So there's a higher high than the previous high. So that's why it's called a higher high. So this is a high. Then a point that is higher than the previous high is what is called a higher high. Then this also, if you notice, this is also higher than this. If we draw a trend line now, you will notice that it's all is sloping upwards. If it's sloping upwards, what that tells you is that it's going higher. That's what it means. You see? It's sloping higher. It's going higher, so it's sloping higher. You see that? So this is a high, is a higher high. This is a higher high. This is a higher high. So it continues like that. It just continues like that. As long as you have a high that is higher than the previous high, that's what we call a higher high. It's as simple as that. And what you notice also is that in the lows here, these bottoms here are called lows, right? So we have a low here. We have a low, L, low. So this low now is higher than this low. So we call it a higher low. We call it a higher low. That's what we call it. Now, this low now is also higher than this one. So we call it a higher low. Higher low. And it continues that way. So these tops are called highs. These bottoms are called lows. Now we've identified a high. Okay, now a high that's higher than the previous high is a higher high. A high that's higher than this previous high is a high high. It continues like that. Then for a low, you have a low here. You have a low, a higher low is a low that is higher than the previous high. The previous low is higher. It's higher. You see, this is higher. This is higher. It keeps getting higher. This series, right? An uptrend occurs when the price of a commodity is constantly making higher highs and higher lows. So when you see a higher high and higher low like this, and you use trend lines like this and all that, you notice that it's sloping upwards, sloping upwards. That's why it's called an uptrend. Simple. That's why it's called an uptrend. So let's look at downtrend. Let's look at downtrend. So a downtrend is a bit different. Sorry, let me delete this. Okay, so I'm just trying to illustrate. It may not be as perfect, but it's an illustration. So what you notice is that, remember, we said that higher highs, we said that highs are usually the outer parts. The outer parts of the chart are the highs, while the lower parts of the chart are the lows. The higher outer part is always the highs. The lower parts are always the lows. The outer part are the highs, the lower sides are the lows. So in this case now, what we'll notice now is this. This is a high. This is a high. This is a high. This is a low. This is a high, this is a low. But you notice something. This high is lower than this high. So that's why we call it a lower high. A lower high. Then this low again is lower than this high, so we call it a lower high. A lower high. We call it a lower high, right? Now this is a low, right? This low is lower than this high. This low, sorry, is lower, is not higher, just like this one. So if we use trend lines here now, let's use trend lines here to see what I'm saying. If you use trend lines here, you discover that this is sloping downwards, just all unlike what we were noticing on the other one. The other one was sloping upwards. Look at this one now. This one is sloping downwards. This one is sloping downwards. This one was sloping upwards. So we have a low here. This is a lower point. So we have it, we call it a lower low. We call it a lower low, right? Why a lower low? Because it's a low that is lower than the previous one. Lower low. So this low now is lower than this. That's why we call it a lower low. And then notice this point too. This point is lower than this. We call it a lower low again. And then we continue like that until there is a change in trend. Like I said, remember, trends are usually for specific periods of time. Trends are usually for specific period of time, and they do change. They do shift. Okay, so since they do shift for that period of time, this is what we are going to identify. And whenever we identify a downtrend like this with with lower highs and lower lows, let's go there and see. So we said an uptrend is consistently making higher highs and higher lows, higher highs, higher lows. Then a downtrend is what? Consistently making lower highs and lower lows. So you see, lower highs and lower lows. That's what gives you a downtrend. So whenever you identify an uptrend, what you are looking to do is to buy. Whenever you identify an uptrend, all you are doing, what you are looking for at that time is to buy. The only thing that will now be left is, where do I enter? Where do I enter? That's the only thing that's going to be left. But the concept, first of all, you have to understand, what are you even going to do in the first place? Before you think about where do I enter, you have to think about, know what you are going to do, what you are supposed to do, what you are expected to do. You are going to know what you are expected to do, right? For an uptrend, you are expected to be buying, looking for a buy trade. For a downtrend, you are expected to be looking for a sell trade. Because if you start to buy in a downtrend, it's like what we illustrated earlier when we say you are going against the tide, you are going against the waves, you are going against the tide. You cannot survive going against the tide. You cannot survive going against the waves. The same thing goes for if you see an uptrend and you start to sell. You cannot sell in an uptrend. If you sell in an uptrend, it's like going against the tide, going against the waves, and it doesn't end well. It always doesn't end well, right? It doesn't end well. So what you want to do is to make sure that you are in a buy situation, or you are looking for buy trades in an uptrend, looking for sell trades in a downtrend. Okay, so now what's the next one? The next one is a ranging market. A ranging market. So a ranging market is what we said before. We said a range is a sideways market. Sideways. See, so in a sideways, a sideways trend or a range is a sideways or a range bound market. Okay, so let's identify what that looks like. Let's do what that looks like now. So we'll look at this. So this is what you call a range-bound market. This is what you call a range-bound market. There is no clear direction of, you cannot say it's going up, you can't say it's coming down. That is what you call a range market. You can't say it's coming down, you can't say it's going up. You can't say, oh, this is an uptrend. You can't say it's an uptrend, you can't say it's a downtrend. It is neither an uptrend or a downtrend. That's why it's called a range. It is not an uptrend, it is not a downtrend, so it's a range. So in this case, what do you do in a range? There are two possibilities you do in a range. There are two things you are likely to do in a range, or you are expected to do in a range. Number one is to wait for price to break out of the range. You know, we talked about before the breakout. We said price is going to go up and down within a roof and a floor. Within a roof and a floor like this, price will go up and down within a roof and a floor, right? If it gets to a roof, it will come down. If it comes to a floor, it will go up. If it gets to a roof, it will come down. It continues like that until what happens? Until it breaks out of the range. Until it breaks out of the range. So two ways you can do this is you can wait for a breakout of the range. Usually a breakout is more is a safer bet than the other thing you are going to do. And the other thing is this, is to basically play this trend, play this range market. What that means is this, you just enter for a sell at the resistance, or price gets to a resistance or a roof, you sell. It comes down again to the floor. When price gets to the floor again, you buy. It goes up again. When price gets to the roof, you sell. You just keep doing that and doing that until there's a breakout. The only challenge here is that you may not know when that breakout is going to be. You may enter here now to buy because it has gotten to the support or gotten to the floor, and that's when it now breaks out. And that's when it now breaks out, because whatever happens, there's always going to be a breakout. There's always going to be a breakout. There's always going to be a breakout at some point. So it's always going to do this at some point. It's going to break out at some point, but you don't know. The issue is you don't know when it's going to break out. So what you can do then, depending on the kind of trader you are, if you are a shorter term trader, you are looking to just take quick 10 pips, 20 pips, and you're out of the market, you can trade it very small like this, trade up and down within a range, But if you are a longer term trader, you may not be able to trade this like this. You'll be in trouble. You might enter and then the move from this top to this bottom here doesn't impress you. You are somebody that expects larger moves in the market. So you understand that better when we talk about the different types of traders, right? But then if you are someone who likes to trade long term, you like your trade to run for a whole day or 12 hours or a whole lot of time or 2 days, you will not be able to trade this range. You will wait for it to break out, because usually when it breaks out, this breakout is usually a safer trade. It's usually a safer bet when it comes to trading. This breakout is usually a safer bet, because when a breakout happens, like at a support here now, we've said that this is support, this is a floor. When price breaks out of here, there's the likelihood that price is going to keep going down. It's going to keep going down. It's going to continue to go down for a very significant amount of time. It is going to keep going down, right? So when it breaks out from the top, it's going to significantly go up, higher, much higher. So that's the reason why people who want to trade and take a larger amount of pips, a larger amount of movement in the market, remember, the larger the movement you take in the market, the more profits that will accrue to your account, right? So since that is what is happening, what you want to do might be to wait for it to break out. But that just means that you are going to be a lot more patient than somebody who is just trying to take a little pips and leave the market. So the only game you are playing here is the game of patience. So if you are someone who is that patient and you want to wait and okay, I want to take a much bigger move in the market, I want to enter more secure trading opportunities in the market. We call them higher probability trades. So if you are entering a higher probability trade, or you want to enter into a higher probability trade, you might want to wait for the breakout. Okay, so these are the three types of trends that we will see in the market all the time. Like I said before, all of these things, we are taking them in bits now together. This whole thing we are doing now comprises what we call technical analysis, and we are taking them all in bits right now. So what we are going to then do after is to tie it all together when we have put the whole bits and pieces together. When we talked about support and resistance. Now, yesterday we went into swings. Now we are talking about trends. There are other things we are going to be still going into, right? There are other things we are going to be going into as well. By the time we've gone through, we'll now be able to put all together. But in the meantime, as we are doing that, we need to be able to see what's going on. Use that thing to begin to see what's going on in the market. What is it that's happening in the market, right? So now, let's look at something very quickly here. Just as we are looking at this right now, this particular trade is a Euro CAD trade. You see? Euro USD, Euro CAD. This chart we are looking at now is a Euro CAD chart. So if you look at this chart right now, can you see that this is clearly a downtrend? This is a chart that has been trending down for a while. It's been trending down for a while. Look at it. It's been trending down for a while. So you are going to, like I said, you are going to notice, you will notice that there are series of higher highs and higher lows here. Higher highs, higher lows, higher highs, higher lows. What are we saying? Sorry, is it higher highs, higher lows? No. Lower highs, lower lows. So this point now is what we call the highs. So on this chart now, this outer part is what we call the highs. This outer part is what we call the highs. So this outer part here is what we call the highs. The outer part here is what we call the highs. The highs. Then the bottoms here are what we call the lows. These lows, these are the lows. These are the lows. These are the lows. That's what we call the lows. So this is a real chart now, Euro CAD. So we are looking at a sell, we're looking at a downtrend on this right now. So these are highs now. This is a lower high, this is a lower high, this is a lower high. It just keeps coming down, right? Like that. This is a low because it's under. So now we are seeing a lower low here. Let's put a trend line. Let's put a trend line to draw. Let's draw a trend line here. Let's draw a trend line here so that we'll start to see what we are doing. You see? So what this you can see now, this is a low, this is a lower low, this is a lower low. Now it tells us now that price is likely to still come again to this area now to give us another lower low. To give us another lower low around this place. But if that doesn't happen and price starts to go up from here, once price moves away from this area now, we see that there's a change. There's a potential change in trend. So that's why we use trend lines. So this class, I don't want it to be too long. So I will not go into the chart itself right now. This just happened to be on this chart. That's why I'm saying it right now. On our next class, I want us to go deep into the market and actually begin to look for these trends. That's what we're going to do on our next class. We'll go and look for this trend. These trends we've done today. Now we want to go into the chart and start to look for the downtrend, the uptrend, the range bound trades. How exactly are we going to trade them? How exactly are we going to trade them? That's what we're going to do on our next class, right?